have the single period inventory. These are some products like Christmas trees and bathing suits that are highly seasonal. Others are easily perishable, so flowers for example, or they become obsolete very quickly, such as today's newspaper. These products cannot be carried in inventory and sold in future periods. In these situations, a buyer places a single pre-season order for each item. Then, at the end of the season, either the product has sold out or there is a clearance sale on the surplus stock. One of the characteristics of the single period inventory is that the salvage value of these products is less than their original cost. So, you lose money when they are sold for their salvage value. So to better understand single period inventory, I have prepared a sample problem. So the problem states that each year, the chic shop buys the latest women's fashion spring suit for $80 a piece and sells it for $125. It also has a fixed cost of $100,000. Surplus suits are sold for $20 each during an end of the season clearance sale. Each season, management wants to order the number of suits that will maximize expected. Additional data includes the probabilistic forecast for each demand level, which shows that there is an 11% probability of selling 8,000 units, 62% probability of selling 10,000 units, and 27% probability of selling 12,000 units. Obviously, if the exact sales level were known, the solution would be easy. The company would simply order the number of items necessary to satisfy demand. Unfortunately, these situations usually involve considerable demand uncertainty, and this uncertainty necessitates an analysis based. Although the buyers do not know the exact demand ahead of time, the probabilistic forecast indicates that it could be between 8,000 to 12,000 suits. Thus, there is no sense in ordering fewer than 8,000 suits or more than 12,000 suits. When the shop orders the number of suits demanded, it will earn a profit of $125 less the variable cost of $80 and the fixed cost of $100,000. For example, if the management stocks 10,000 units and 12,000 units are demanded, gross profit will be $125 less $80 variable cost times 10,000 units less $100,000 fixed cost, resulting in a gross profit of $350,000. On the other hand, if Chic Shop orders more suits than the quantity demanded, it will salvage the surplus for $20 per suit. In this case, the revenue is less than the cost and there will be $60 loss per surplus item. Therefore, when 10,000 units are ordered but only 8,000 units are demanded, profit will be $125 less $80 variable cost times 8,000 units less the fixed cost of $100,000 less the loss of selling the surplus units at a salvage value of $20, so that will be $20 less $80 variable cost times the surplus of 2,000 units, resulting to a gross profit of $140,000. This table presents the profit data for each order quantity and demand combination. Using these profit data and the probabilities forecast, the shop can compute the expected profit of each order quantity. For instance, when Chic orders 8,000 units, management can expect a profit of $260,000 by getting the sum of $260,000 gross profit times 11% probability for 8,000 units plus $260,000 gross profit times 62% probability for 10,000 units and $260,000 gross profit times the probability of 27% for 12. In conclusion, if Chic wants to select the inventory policy that maximizes expected profit, Their management should order 10,000 units each season. Such a policy will result to an expected return of $326,900 per order. Small inventory problems can be solved rather quickly by using the preceding expected value approach. However, the method becomes quite cumbersome when there are numerous alternatives. In these situations, incremental or marginal analysis provides an efficient way to select a decision alternative. Incremental analysis is a decision-making technique used in business to determine the true cost difference between alternatives. This is also called the relevant cost approach or differential analysis. It focuses on relevant data such as the revenues and costs that will change if it accepts the special order. It is a problem-solving approach that applies accounting information to decision-making. It is also an approach to simplifying complex business decisions. Incremental analysis can identify the potential outcomes of one alternative compared to. For us accountants, we are quite familiar with incremental analysis and the most common examples where it is applied, including accepting additional business, making or buying parts or products, selling products or processing them further, eliminating a segment, and allocating scarce resources or. The objective in using incremental analysis is to identify the alternative with the least relevant cost or the most relevant revenue. The difference in the sum of relevant cost is either called incremental cost or net benefit. Consequently, the alternative with a favorable incremental cost, sometimes called net benefit, is a desirable alternative. Since this tool relies strictly on estimated cost or revenues, and because the margin of error can be significant, different computations of incremental cost should be made based on different cost assumptions. The finished product is composed of raw materials and components. During production, the inputs are transformed into the desired end item. Therefore, when there is a demand for the end item, the production process will generate an accompanying demand for each input. In effect then, requirements for materials and components are derived from the demand for the finished product. This is basically a dependent demand type of inventory. Production of the finished goods cannot even begin without the required inputs. Thus, it is important to provide raw materials and work in process in the correct amounts and at the right time during the manufacturing process. To do so, management must design an inventory system that accounts for the dependency between end item and raw material demand. This is where material requirements planning takes place. Material requirements planning is a standard supply planning system to help businesses, primarily product-based manufacturers, understand inventory requirements while balancing supply and demand. Conceptually, there are two related decisions about ordering: timing and quantity. The objective of the material requirements planning is to develop a work and purchase order release plan that accounts. Inventory activities can be an extremely expensive phase of a firm's operations. Hence, it is important for managers to make correct decisions. Since quantitative models can help decision makers develop sound inventory policies, these techniques offer a potential source for substantial cost savings. That is all for my report. Once again, have a good day and thank you.